Rates live with the mortgage calculator. We appreciate you tuning in. We're going to go through some live rates today and do a deep dive into self employed borrowers, but we're going to wait just a few minutes here to go live on all the different platforms and give everybody a chance to tune in. We are streaming this live on YouTube, Facebook, and LinkedIn. And we did put the chat up on the screen, so feel free to drop a comment there as you tune in. And we will get started here in just a moment. I hope everyone had a great weekend and is ready to have a great week. And for you loan officers out there, ready to close some loans. Just give us one moment to get started. I see some people already commenting there. Appreciate you tuning in nice and early. We'll get started in just a moment. All right, it looks like we are live on all the different platforms, so we can go ahead and get started. We'll go ahead and take the chat off there, but keep dropping comments in the chat as you tune in. We'll get the show underway here. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. What we do on this show every morning is go through the live mortgage rates for different programs, and then we do a deep dive into a different topic every day. Now, we are a correspondent lender that specializes in non-QM loans, and today we're going to venture into some of those non-QM loans when we talk about self-employed borrowers for our deep dive. So our sales manager, Jose Gonzalez, with 27 years of experience as a loan officer and a realtor, is going to talk about self-employed borrowers and the different types of programs that we can put them in. But before we do that, we'll do what we do every morning, which is pull up our pricing tool and go through the live rates for this morning. So Nick, let's go ahead and pull up the pricing tool and see what the market is looking like this morning on a Monday.
All right, let me switch my screen and we will check it out. So as Kyle mentioned, this is our pricing tool for our mortgage professionals. This will show us the general rates. It's just after 11 a.m. Eastern. It's Monday. It is July 24th. So most of our programs have some live rates already from last week. So we'll go ahead and check out those updates as well as the APR, including all the fees. If you'd like a full breakdown of all the fees and a itemized loan estimate, please give one of our team members. We have over 300 licensed loan officers in 24 states for primary and second homes. And we can do our DSCR business purpose, one of the loans we love, in 44 states total. So for all of our demos today, we'll compare our programs using the same scenario. We'll set up a $400,000 loan amount, set up an LTV of 80% loan, 20% down payment. We'll set a desired price of $99. That means we're going to ask the computer to find the best rate at one discount point in cost. And we'll compare our programs. We'll start with conforming conventional. Then we'll check out our FHA, usually the next option. Then we'll go into expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs using alternative income. Definitely going to be one of the topics that Jose is going to go over, I'm sure, in the self-employed borrower scenarios. We also offer VA and USDA. Those are VAs only for eligible service members and veterans. So if you do happen to be eligible, let us know. We can quote it in a couple clicks. And same with USDA. If you do happen to be shopping in a USDA eligible area, please let us know. But since not everybody is, we don't do those live. So we'll start today with conforming, conventional. We'll do a purchase, 30-year fixed loan, primary occupancy, single family home, 1 unit, state of Florida, county Miami-Dade, and a estimated FICO score of 760 for all the demos, and an estimated debt to income ratio of 40%. So with the basic settings we do every morning, let's check out the rates today. Nice. Looks like it's gone down a little bit already. Hopefully we see some more downward movement today. Best option, 6.875 for one discount point in cost. Puts our final APR at 7.042. So just a touch over 7 here for conventional. And remember, APR is what we're going to use to compare apples to apples across the different programs. So if our customer doesn't qualify for conforming conventional, Let's check out the next option, which will usually be, set the same scenario, an FHA program. So with all the same basic settings, typically the next option will be FHA. That will allow a little more leniency on some credit type of issues, as well as a much higher debt to income ratio. However, we'll keep everything exactly the same, so we can compare apples to apples across the programs. So let's see what the FHA options are this morning. So 6.125 rate, the best option, 0.875 discount points, puts our final APR at 6.713. So it's actually a little bit below 7. So in this case, if our customer qualifies for both programs, we would actually save a little bit of money here for our customer under FHA, even though there is upfront and yearly mortgage insurance required for FHA. It's actually a touch cheaper. And our customers that only qualify for FHA definitely get that benefit of those recent changes to the program. So definitely do not discount the FHA. It's actually a touch cheaper in some cases. Now, where we love to specialize here is if our customer doesn't qualify for either conventional or FHA. Many other banks or lenders don't have other options, but that's where we specialize with our expanded guidelines, also known as non-QM, and will be one of Jose's topics later. So if we keep everything else the same, you notice when we select non-QM, we have a new option where we can select different income. So for our non-QM options, we will typically choose something besides full doc. Full doc is what we have to use for FHA, conventional, that's 2 years of tax returns. So we'll typically choose this for another option, such as asset-related programs, business bank statement programs, our investor DSCR programs, we'll talk about in a minute. Personal bank statement 12-month, the most popular program by far. And we still have RSU, stated, VOE, 1099, P&L, and CDFI, no ratio, all kinds of different options. But again, the most popular option for a primary home purchase is a 12-month bank statement program. And that's typically used for our self-employed borrowers. Many times our self-employed borrowers, when they submit 2 years of tax returns, will have different write-offs and may not qualify or may not quite have enough income on their qualification as they need to get that home they really want. So in this case, we solve that problem by using alternative income. No tax returns involved at all. We simply use our last 12 bank statements to determine a debt to income ratio of 40% in this example, using their bank statements alone. So most self-employed borrowers will qualify for double or triple or even higher income and therefore can qualify where they would not before. So these non-QM programs are amazing solutions for our borrowers that need a little extra help. Now these rates will be a little bit higher. The best option is 7.5 rate for 1.625 discount points and costs, puts our final APR at 7.587. So remember, conventional programs were just over 7. So we have a non-QM option using bank statement income for just about a half a point higher. So we love these options for our borrowers, especially when there's no other option really for a conventional program. These are very comparable options. Not only that, but if you scroll down here, you see there's dozens and dozens of different programs. Some of these at a little bit higher rates may allow things like bankruptcies and foreclosures and other credit type of events. So we can get around other guideline issues, not only qualify with more income, but also solve other problems as well. So that's why we love our non-QM programs. Now for our final demo, before we go into Jose's deep dive examples into some specific non-QM options and conventional, of course, we always want to do our investor rates. So we love to work with investors, whether you're a first-time investor or seasoned investor. We have a ton of options. So let's check out some simple scenarios here, as we do every morning. Set up the same demo, 80% loan amount, 20% down payment. And we'll compare our options here, conforming, conventional. Obviously, we can do for investment properties, and our non-QM. Remember, the government programs, FHA, VA, and USDA, are not eligible for investments. So we'll start with conforming. Everything else will stay exactly the same as all our demos. We've only edited the occupancy here. So now we can check out the adjustments that the conventional programs have added for investment property. So good rate here, 7.375 for 3.75 discount points and costs, puts our final APR at 7.633. So many times our investors that look at these would ask for options at a higher rate in order to reduce these discount points. In this case, 3.75 points in our example is $15,000. that our investor would like to deploy elsewhere if they can raise the rate a little bit. Unfortunately, with conventional, there really isn't any higher rates we can go to reduce these discount points because of the changes here. So that's where we love to present our non-QM options. So for the final example here, we'll set up the same scenario, 80% loan to value, 20% down payment, and we'll go for our expanded guidelines non-QM investment property options. So first we have to select our income as we did before, and the most popular option by far, and the most popular loan we do by far, is our DSCR loan because it doesn't require any income or employment actually from our borrower. We're simply going to use the estimated rental income from the property we're purchasing in this case to determine a DSCR value. It stands for debt service coverage ratio. If the estimated rents can cover the PITIA, the mortgage payments, and the property cash flows on a monthly basis, that's a ratio of 1.00 or higher. Property makes more money than it costs on a monthly basis. We also have loans for ratios under 1.00, aka the property doesn't quite cash flow on a monthly basis. So, ton of different options here. I always put 1.5, that's the highest value that we go to, so that way we can see all the different options pop up. And the final thing we need to select is a prepayment penalty that is standard on a non-QM investment property. So we always do 3 years for the demo. There are options for 0. Not all loan programs allow it, and it will cost more. And there are options for a 5-year prepay, which will save us some money for our borrower, but not all loan programs allow it. So we always do 3 years on our demo. So with these settings, let's check out the DSCR options this morning. So 8% rate for 0.975 discount points and costs puts our APR just a touch over 8 at 8.066. So remember the conventional was 7.6 something, I believe, in our demo there for just a touch higher cost here. Again, we love when these non-QM options are very comparable. Most investors, when they're presented with both options, will typically choose one of these DSCR options. Not only does it save, in this case, $3,900 is the out-of-pocket discount points here. So the investor saves tens of thousands of dollars they can deploy into another investment. But also no income, no employment means our investors can do multiple loans at the same time to cash out multiple properties, purchase multiple properties with no restrictions. So ton of flexibility here with the DSCR program. Most investors, when you compare side by side, will typically choose one of these options. And if you scroll down here, you see we have a ton of different scenarios with different prepayment penalties. Some of these may allow short-term rental income. Some may allow bankruptcies and foreclosures. So a ton of different options here once we go through the non-QM. So please let us know what problems we can solve for you. Now, let me introduce Jose's topic for today. As we do every day, we're going to do a deep dive with Jose into some examples. Have a little bit of a mysterious topic for today. Pretty general here for self-employed borrowers. So in our demo every day, we always do our non-QM self-employed borrower example for bank statements. So that's one of our most popular options. So that's kind of the direction we're going here. But I'm sure Jose has some other tips and tricks up his sleeve that we can use for our self-employed borrowers with these different loan programs. Specifically, our non-QM loan programs are one of our favorites here when we have our self-employed borrowers. So let me go ahead and make you big, Jose, and we can introduce your quotes and then go into some live examples.
Good morning, everybody. Thank you for joining us. Daily Rates Live with the Mortgage Calculator. Great to be with you here today. So, yes, I am throwing out a few different twists to the self-employed borrower, from the obvious to the less obvious, just because I want to be able to put the situation in some nice context here. Because we do have automated underwriting options, and then we have our non-QM options. So let me jump right into it here because I do have a few examples to share. In our more obvious options, when we were discussing Freddie Mac loans last week, I did mention how Freddie Mac is our preferred conventional loan option for self-employed borrowers because of the way that Freddie Mac analyzes, or the Freddie Mac guidelines allow you to analyze the borrower's income. And what I'm specifically mentioning here is the fact that Freddie Mac lets you use ordinary income instead of distributions. Because normally, when you go Fannie Mae requires you to use the lower of the two figures. So if distributions is lower than ordinary income, which it usually tends to be, Fannie would have you use the lower amount. Freddie allows us to use the higher amount when the business has liquidity. Hence, I'm putting the Freddie Mac full doc option as our self-employed borrower conventional loan of choice.
That's our preferred route, you're saying?
Yes, correct.
Gotcha.
Because if in the scenario where we have a borrower with $100,000 in ordinary income claimed on the K1, but only $20,000 in distributions, if you were to go Fannie, that borrower's income is $20,000. No ifs, ands, or buts. If you go Freddie, and you can show that the business has liquidity by running the simple liquidity test that Freddie also provides a worksheet for, then you can use the ordinary income of 100,000, even though the distributions were only 20,000. So that would be the Freddie Mac hack to the self-employed borrower. Real easy if you don't know about this guideline specific. That you could end up really coming up with the wrong conclusion, let's just put it that way, for the loan, which could easily be approvable. So here we're looking at conventional loan rates with at a 95% LTV. There are not any loan level price adjustments of any type for self-employed borrower using tax returns versus our non-self-employed borrower that could be using W-2s and pay stubs. Same rate. The only thing that's going to change the rate here is going to be your loan to value and your score. So here you're looking at pretty good rates, 7.375 with a little bit of a lender credit, and you can buy it down to 6.25%. Now, remember, conventional loans are all automated underwritten. So if you're not able to obtain your automated underwriting approval, whether it's an approve eligible for Fannie or an accept for LP, then your next option would be to go non-QM. So here we have a non-QM full doc. Same borrower. The only difference here is we're assuming that we were not able to obtain approve eligible for DU through DU, or maybe we needed that 1 year tax return findings in order to have our borrower qualify because the previous year was not very good. Using the 2 years average was going to bring us below our target. So in this case, since we were only able to get the 2 year findings, we opted to go non-QM so that we can choose the 1 year option, and then hence our borrower qualifies. Now you will note rates are a little bit higher. Maximum LTV is 90%, but our borrower does qualify for the home that he wishes to buy at the price range he needs to be able to offer to obtain that property. So 8.875 has a little bit of a lender credit, and we can buy it down to 7.875. Now, this is with 10% down in this option here. Now, same non-QM borrower who wants to go 20% down, you will note rate gets substantially better. 7.875 has a little bit of a lender credit, and you can buy it down all the way to 7.5%. I'll put the 90% LTV option again in a minute, just so you could compare. You're looking at 8.875 here versus 7.875. So the rate does drop a full 1% when you go to the 80% LTV option. So now, these are some of our outside the box options here. When full doc just does not work for your borrower, we can go with our bank statement option. Now, this option here is a 20% down option, and you'll notice that these rates are very good. 8% is has a little bit of a lender credit, 7, and with the lowest rate buy down option, 7.375. Now, if I go back a minute over here to our full doc option, you'll notice it's really only about a 0.125 difference in the rate between our traditional full doc option and our bank statement option. Same borrower, same credit score, same LTV. We just went with 12 months business bank statements versus tax returns. Right, so this is our non-QM bank statement, 20% down. Now, same purchase here, 10% down. Now, mind you, at 10% down, it's only primary. The last example of 20% down was for primary as well, but 10% down, only a primary option. So our rate does go up a little bit. You're looking at 9.25% with a little bit of a lender credit, and you can buy it down to 8%. But this is 90% LTV, which is our maximum LTV for the bank statement option. Now, we have the same bank statement option, which is the most popular non QM option. Uh, and this is 15% down purchase, which is the minimum down payment. 85% is the maximum LTV for an investment property 1 unit bank statement purchase. So here you're looking at 9.875 as the lowest cost option, and you can buy it down to 8.99%. So again, bank statement option is the most popular non-QM option. And now throwing a couple other little twists to it. If your bank statement loan does not work out, there's a number of different reasons why a bank statement loan would have issues. You have the issue of too many NSFs or overdrafts. You could have the issue of declining deposit trends, negative ending month bank balances. I mean, there's a lot of different things that could throw your bank statement loan off track. If that is the case, the profit and loss option would be an option to remedy that situation. However, if the issue with the overdrafts are in the last 2 months, keep in mind that usually these profit and loss programs are going to require you to provide anywhere from 2 to 3 months most recent business bank statements to substantiate the P&L. So it's not just strictly a P&L. You do have to provide a little bit of supporting documentation from the cash flow. If you can do that, you're looking at 9.625 as your lowest cost option, and you can buy it down as low as 8.875. So we do have investment and we do have primary options for this. I was just showing you here the investment option, which is the one with the lowest LTV. You can do 90% on the primary. And last but not least, our 1099 option. Very good option here. I have it for a primary purchase with only 10% down. This is a great program. For example, real estate agents that all get paid usually with a 1099. Very good option. I mean, you get a lot of licensed individual and unlicensed individuals that get paid with a 1099 that could all take advantage of this. The biggest benefit to the 1099 program is that there is a fixed expense ratio, which is much more favorable than the bank statement, where you can capture as much as 90% of the 1099 amount using the 1099 option. So very good option for your self-employed borrowers. 7.625 lowest rate option. You can buy this one down all the way down to 7%. So this is great option for your self-employed borrowers that receive 1099s. Much better option than the bank statement or the P&L option. So very wide selection here of choices for your self-employed borrowers.
Perfect. Well, lots of great options there, and this is something that we specialize in at the Mortgage Calculator with self-employed borrowers. So if you want more information on these type of loans, you can visit us at themortgagecalculator.com. We can pair you up with one of our 340 loan officers all across the country. We are licensed in 24 states for primary residences and second homes, and then we can do business purpose loans, investment properties such as our DSCR loan in up to 44 states. We appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. And we do this show every single week, every single morning, 11 a.m. Eastern on weekdays, where we go through the live rates and we do a deep dive into a different topic. So thank you, everybody, for tuning in, and we hope to see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Everyone have a great day.
Thanks, everybody.
Good morning. Thank you, everybody.